Have you ever walked down the street past all the little shops to find them oddly impersonal? Or been informed that your company was getting bought out by something that had such a bland name it made you suspicious of what it actually does? Something like Vision Innovation Vest Capital Partners. Well, for several decades, the booming industry of private markets has been the place to be. And while this approach to investing has been around for a long time, the past few decades have seen what were a few innovative firms take off into an absolutely sprawling web. The staggering growth of this sprawling industry has been fueled by the ever-increasing investment from institutional funds. But is it really the wealth generation machine it appears to be? Or is it a facade? Private investing has been around as long as there's been investing. And while the first examples of investments that look something like today's private equity go back to the medieval period, we start to see it really take form in the 18th century, when investors would invest in ship voyages. In the 19th century, it begins to really take form, and we start to see something that could be described as levered buyout, with major investors like JP Morgan. And once we get to the 1960s, today's industry really starts to form, with Lewis Coleman's acquisition of Orkin often cited as the first example of the modern strategy. In the 1980s, levered buyout and corporate rating strategies exploded, with huge sums of money being made. KKR's RJR Nabisco acquisition perhaps being the crowning achievement of this era. And though tactics changed over the years, with a growing economy and ever-dropping interest rates, private equity investing became the place to go to make big money. But there's a problem. The people who have dominated this industry for decades have only seen rates go down. From the beginning of the 1980s until just a couple years ago, they went down all the time, until they went up. So what happens when you take an industry that's highly levered, values its investments and returns on past valuations in lower interest rate environments, and who has investors who are themselves levered, and you raise rates? Well, I guess we're going to find out. So how do you value something that there isn't an observable market for? Well, the private equity industry has come up with a few standard methods. You could look to the public markets, where companies are very liquid and frequently traded, find a company that's somewhat similar, maybe change a few values here and there, and try to come up with a comparable that way. You could look at other private deals and see what something similar has traded for in the past. Or you could try to value it out yourself using discounted cash flows. Let's look at the first one, publicly traded comparables. The first problem that arises is what exactly is comparable? That right there gives the manager a lot of latitude in valuation. Next we come to the problem of an illiquidity discount. If an asset is illiquid, it will generally sell for less. So some discount has to be applied. But what an appropriate illiquidity discount is could change over time. If a bunch of funds started dumping private equity investments into the secondaries market, then not only would the selling pressure push down the price like in public markets, but that illiquidity discount would become larger and larger. Investors would accept steeper and steeper haircuts just to dump their investments. In the secondary markets, 10 to 30% discounts have been observed from the net asset value calculated by managers. But in any real stress test, this could prove to be wildly insufficient. How about private transaction comparables? Well, again, we come back to that judgment call of what is a comparable. But keep in mind the interest rate issue. Interest rates haven't been this high in decades, and even back when they were dropping. So if you were to look at a past transaction, it would be overvalued on that merit alone. And discounted cash flows is perhaps the most arbitrary of all. Every step of the way is a judgment call. Because of the change in interest rates, because of the lack of real stress events, and because of the amount of latitude that managers have when valuing their portfolios, there is an enormous opportunity to overvalue these investments. And since these managers collect fees based on how much they grew the investment, Well, that has to make you a little bit skeptical. So if someone came along and said, I can get you into all of these fantastic private investments, we can use leverage, use experts who know the industry inside and out, and we can engineer returns way above stocks, how much would you pay? Well, while the fees on these funds have generally come down over time, they've come down from a very high starting point. 2 and 20 was the standard for a while, and even now, you still see 2 and 20s. Sometimes 1.5 and 15, or down to 1 and 10. So what does this practically mean? Well, it means you're paying a 1 to 2% fee on your committed or sometimes invested capital. And you're paying a 10 to 20% fee on any of your returns, which is substantial. But surely it's worth it if you're getting these magnificent returns. Well, that's if you're getting these magnificent returns. And those fees might not be all of them, as many of these funds have hidden fees. These firms often charge fees to their portfolio companies, which is a chunk of money the investor never gets to see, nor know was even ever there. Monitoring fees, transaction fees, financing fees, various administrative fees, all sorts of fees that pile up. And that's assuming that this is a direct investment. Increasingly, LPs are investing in private equity funds of funds, which have manager and incentive fees on a portfolio of funds that have manager and incentive fees, which additionally charge fees to portfolio companies. The hidden fees collected by this industry is entering the tens of billions of dollars. So how much do these fees actually eat up your return? Let's look at some examples. For the sake of these examples, let's assume that fees are on committed capital. And oh wow, do they add up. Right here's the total return assuming a 10-year fund that returns 20% per year. And the moment we start adding these fees, we see that there is a huge drop-off in total return. Add in some hidden fees of, let's just say, 0.5%, and that's another huge hit to return. But if we have a fund of funds structure, then we're seeing that returns are almost cut in half. So let's look at how much you would make over the life of your investment. And let's say you committed $1 million to the fund. We can see that as these fees start to add up, you can go from making $5 million to just about 2. So how much are you missing out on? Well, we can see by just adding these little fees that look like they shouldn't be a big deal, you could end up missing out on an amount that's greater than your initial investment in only 10 years. And keep in mind the incentive managers have to value their investments as high as possible, because the higher the value of the investments, the greater the fees. So we have highly illiquid investments whose managers are incentivized to value them as highly as possible, and whose past comparables were valued in a low interest rate environment. There's an old saying from the boom time of hedge funds: come for the high fees, stay for the underperformance. Well, if that was a problem then what exactly is this? And hedge funds typically have public market investments. Investments where you can see the value instantaneously, or at least it won't take that long. With private equity investments, there are no observable market values. So looking at the sheer magnitude of these fees, you can see why this has been the place to go to get rich. But the question now is, how long will people keep paying? There's a great idiom that comes from banking: extend and pretend. Say you're a banker who has made a loan and the borrower isn't able to pay it back, but you think that maybe sometime in the future the borrower might be able to. You don't want the borrower to default on the loan, so you say, hey, you don't have to worry about that payment. We're all buddies here, I'm sure it'll be fine. Pay it later. And the borrower says, sure, yeah, I'll definitely be able to pay it later. So you extend, you pretend everything's fine, and hopefully some point down the road it will be. So what happens if you run a private equity fund, and you've been marking these fantastic valuations for years and collecting fees, but you don't have anyone you can sell your portfolio companies to? Well, maybe you could sell it to another one of your funds and hope that that fund can offload it one day. Or you can go to your investors and say, hey, There are great deals on the horizon. You're gonna make so much money. We just need a little bit more time. Don't worry, you're gonna make a lot of money. But we just need a few more years. Which may or may not be true, but at the very least, you've bought yourself some time. Most private equity funds have the ability to do this written into their partnership agreements. They can extend the life of the fund. Typically, most partnership agreements allow for 2 or 3 more years. But we have started to see some funds go well beyond that. Some funds have even started writing sneaky covenants into their partnership agreements designed to force investors to invest in a new fund of theirs in order to get their money out. And while some funds genuinely are on the verge of finding a great deal or just need another year or 2 to IPO, some seem to be extending and pretending. This has become particularly prevalent amongst private debt and private real estate funds. So now, on top of the already existing illiquidity risk that may not be adequately accounted for, investors are finding themselves stuck in these investments for years beyond what they were expecting. And IPOs haven't been all that active lately, so clearly that's not why the extensions are needed. Since around 2023, when interest rates started to rise, it's been increasingly difficult for GPs to offload their investments at prices that give a good return. It's not that hard to lever up a company and sell it for way more than it's worth when interest rates are near zero. But when money actually costs money, it's a very different situation. And especially with a slowdown in IPOs, you can value your portfolio companies pretty high all you want, but that does not mean that you will be able to sell them for that valuation. So, limited partner investors find themselves in a situation where their money is locked up for 10 plus years, looking at investments that they don't know the actual value of, paying fees on those valuations, all while the opportunities to sell them have gotten worse and worse. So if you're a private equity manager and you want to collect those huge fees, you need a whole lot of money to manage. You could nibble away at a whole bunch of small investors, but what you're looking for is institutional money. Pensions, endowments, and foundations. Enormous treasure chests just looking for someone to manage their money. With billions of dollars, dedicated managers, and top-rate consultants, these are the big boys. Governed by ERISA, the Employee Retirement Income Security Act, there are rules and oversight in place making sure that your pension is being taken care of. And with dedicated teams of experts, how could they not be? Well, ERISA covers private pension plans. So how about the public plans? While I'm sure that governments would never screw up finances, people often assume that the public plans must be the best governed because they're overseen by public entities. But they have less oversight, less transparency, and generally less accountability. That's not to say that their managers are doing anything unscrupulous, but take a fireman's pension, for example. These guys don't have any financial experience, and suddenly they find themselves tasked with overseeing and securing the retirements of their employees and coworkers. What would you do in that situation? Well, generally they're trying their best, but this leaves them open to a lot of bad advice. And remember when I mentioned institutional consultants? Well, they make money on assets under advisement. But increasingly, in order to navigate private investments, pensions are turning to private equity consultants. And those guys make money when you invest in private equity. And if we look at how much pensions have been investing in private equity, it's been ballooning. And not just has policy allocation been increasing, but we've gotten to a point where most pensions are above their target allocation. This is the money that people rely on to retire, and they're wildly over-allocated to private equity investments that are unobservable and illiquid, all while huge fees eat away at their return. How did it get to this point? Well, over decades of ever-decreasing interest rates, bonds stopped offering the return that was needed to guarantee pension obligations, so they looked for something else. So these funds started going further and further out along the risk curve. And if anything, that illiquidity that there should be a discount for has started to become a benefit sometimes. Since these investments are only valued quarterly, the funds seem a lot more stable than they are, which allows them to show steadier and better funding statuses than they would otherwise. So there's almost starting to become an illiquidity premium. So they keep adding more and more risk with advisors telling them to add more and more. They see steady, fantastic returns and keep adding. They keep seeing better returns and keep adding and adding and adding. But what happens when the money's not there when they need it? Oh, and if you think that's bad, endowments are way worse. Early on, this industry was marked by a handful of highly creative firms. But as with any gold rush, eventually huge numbers of people hoping to get rich start piling on. These days, the private equity industry isn't just Blackstone, Carlyle, KKR, and Apollo. It's tons of companies, large and small, that nobody has ever heard of. The industry has become absolutely gigantic. A 2021 Ernst & Young report made for the American Investment Council put the total number of private equity firms at 4,500. There are only 4,300 publicly traded companies. There are more private equity companies alone than there are companies in the stock market. And that's before you count private real estate and private credit. And a Harvard Business School study estimates that private equity firms control 20% of the American economy. But just like with the gold rush, when are there too many players? Are there enough good deals left? Well, at a certain point, you have to get creative. Lending between one company and another, selling one company to another one, selling and lending between funds. And if you have low interest rates, you don't even need to do real business. Lever everything up, put the assets and liabilities where you want, bankrupt a company, and walk away with a profit. No business needed, just engineer a profit. But it's a lot harder to do that when interest rates mean something. How much of this industry is just financial engineering and circular deals? I don't know, but it's becoming more and more of it. Deals between your companies, loans between your companies, deals between your companies and your funds, loans between your funds and your companies, deals between your funds, loans between your funds. Passing around levered up assets to engineer a return. At a certain point, it's not real business that you're doing, it's something else. When there are more private equity firms than there are public companies, not funds, firms, how many more good deals are there to be made? How can you possibly have an edge? Well, they'll swear up and down that there are still great deals to be had. But isn't that always said about an inflated market until it isn't? Doesn't it always seem like that? I am sure that some firms really are doing good business and genuinely are adding to the economy, but they can't all be. Now, investors are in a tricky situation where they have to figure out which of these firms are doing real good business and which of them are just levering up, shuffling things around, and hoping that the music doesn't stop.
Behold, the time has come. It's really here. Now you too can be a part of these lucrative funds. Your dream of vast fortune has finally come true. Simply go to your financial advisor to get into one of these funds. But wait, it gets better. There are liquid alternative funds, a new innovative product from our financial heroes to bring wealth to the masses.
As fundraising became increasingly difficult, our innovative geniuses in private equity stuck with these assets thought, hey, do you know who would like this? Everyone. And when a super hot asset gets dumped on the public, you know what that means? It means we're just getting started. Well, usually it means that's the end. Now, just because something hits retail markets doesn't mean it's bad and it's all over, but it's not a comforting sign. Very often when a hot asset has gone bad and they can't find any more buyers, the solution is just to dump it on the public who don't know what they're buying. Now, if the opacity, arcane fee structure, and illiquidity was already a problem for institutional investors with dedicated teams of managers, then what's that going to look like for retail investors? If this industry has such a fantastic product, then why are they scraping the bottom of the barrel? Well, probably because that fantastic growth is over. How much would a typical retail investor or financial advisor actually know about what's in these things? Beyond just being nearly impossible for most people to understand, we're left with the question, why now? What are GPs seeing that has led them to think, hey, the institutional money isn't cutting it. Let's sell this to retail. Maybe these are just fantastic investments and they're now opening it up to the public. Or maybe they can see all these problems, and they know that somebody has to be left holding the bag. Why now? What do they see? Maybe it's worse than I've even speculated. I don't know, but it's a worrying sign. And this raises another troubling question for the industry. If they're at the point of dumping this on retail, what's next? Who's left? I'm pretty sure the answer is nobody. There's nobody left after retail. Just like countless times before, retail is the final greater fool, the one left holding the bag. Now, there very may well be fantastic investment opportunities out there, and an intelligent, knowledgeable retail investor who understands these products could find something lucrative. But that is a very small fraction of retail investors. So, just a question to ponder. Would you be a buyer? And another troubling one, what happens to those who did when it all ends? So, where does it go from here? I don't know, and I don't think anyone can know. It could keep running for years and years. Or a great mark-to-market event could hit tomorrow. Financial markets have a way of staying crazier a lot longer than you'd expect. There could be an enormous sell-off, investors rushing for the door and accepting massive haircuts. Maybe the returns just slowly fizzle out. Maybe the institutions are able to quietly and slowly leave, leaving retail holding the bag. But another question is, when are rates too high for this to even exist? Would a little rate cut solve it? That's hard to imagine. And I certainly can't imagine going back to the zero bound anytime soon. But what's especially worrying are the public pension plans. What happens if they're the bag holders? All those people who rely on them to retire? Do they get bailed out? I really don't know. We've seen a sprawling web of companies who hold opaque assets, charge arcane fees with adverse incentives. We've seen them extend and pretend as a new interest rate environment took form. We've seen institutional money pile in, and when that wasn't enough, retail investors get the pitch. So I don't know what happens, but at some point the music does stop. And maybe we all just have to learn the lesson again, to be wary of things that seem too good to be true.